Financial institutions are organisations that provide financial services to individuals and businesses. They deal with people's money and provide financial products such as current accounts, mortgages, personal loans, investment, and insurance. The first financial institution we're going to look at is the Bank of England. The Bank of England is the UK's central bank. This means it's responsible for the financial stability of the UK. They're not a retail bank like HSBC and Barclays, so they don't offer their services to the general public. One of their jobs as the central bank for the UK is to issue banknotes. There's currently £60 billion worth in circulation at the moment. They also set interest rates. This impacts the amount you'll pay back on your mortgage or personal loan, but it will also impact how much you receive in terms of interest on your savings. Finally, they help supervise and regulate banks so that consumers have faith in the banking system. The next institution are banks. Put simply, banks handle money for their customers. Some well-known banks include HSBC, Barclays, and Santander. Banks offer a wide range of services and account types, such as current accounts to pay in your wages, savings accounts, and accounts to invest your money. They also supply customers with credit in the form of mortgages, credit cards, and personal loans. Banks are a for-profit business, meaning their aim is to make money out of providing you with these financial products. And although banks are a relatively safe place to keep your money, what a lot of people don't know is that if the bank goes bankrupt, then only your first £85,000 is protected. Meaning that if you have more than that in the bank, then anything above that could be lost in this event, which isn't very good if you're in that situation. Next up are building societies. A building society does more or less everything that a bank does. They offer mortgages, current accounts, loans, and savings accounts. Nationwide is the UK's largest building society and is one you've probably heard of. The key difference between a bank and a building society is that the building society is part run and owned by its members and doesn't have shareholders like a bank does. This means that they can prioritise the banking experience for their members rather than thinking about the profits for the shareholders like a bank would. In turn, this can often lead to better rates for their members. The next one isn't as mainstream, but it's called credit unions. A credit union is very similar to a building society on a much smaller scale, as it offers savings and loans to its members. However, to become part of a credit union, you have to have a common bond with other members. This means living in a particular area or being part of a certain profession. For example, the NHS has a credit union specifically for their employees. Being a member of a credit union typically means that you'll get better rates than you would from a high street bank. Next is National Savings and Investments. This is a state-owned savings bank in the UK that offers savings and investments to the public. They are most well known for the sale of premium bonds. However, they do offer other accounts such as ISAs, junior ISAs, and savings accounts. When you save with the National Saving Investments, what you're doing is you're lending the government money in return for interest on your money. Or, in the case of premium bonds, the chance to win a cash prize. And because all their accounts are backed by HM Treasury, they guarantee that your money is 100% safe. The next financial institution is a pension company. These are companies that protect customers from financial loss in return for a monthly or annual premium. Car, home, health, and life are all types of insurance an individual can purchase. For example, when you buy car insurance, you're protecting yourself in the event of an accident. The downside of insurance is the more risky you're deemed to be, then the higher your premiums will be. Again, this is often the case with car insurance, where new drivers, who are usually younger, pay higher premiums than more experienced drivers with a history of no claims. This is because the new driver is statistically much more likely to have an accident and therefore make a claim that the insurance company will have to pay out. Next is pension companies. They provide customers with savings and investment options to help them fund their retirement. Customers often pay monthly contributions to the pension company, who in return for a fee invest that money for the customer, hoping that this amount will grow and therefore fund their retirement. However, pensions aren't risk-free, as they are investing the money into the stock market and other assets in hopes of growing it. This means that these investments could fail, resulting in you getting less back than you paid in. Another downside is that this money can't be accessed until a specified date. that's been outlined in the pension plan. Usually, this is a minimum of 55, meaning that any money put away can't be accessed until you reach this age. The sixth financial institution we're going to talk about is pawnbrokers. There are usually two ways you can use a pawnbroker. The first way is you can take in an item of value and sell that item to the pawnbroker in return for some cash. The downside to this is that they'll offer you much less than the item's actually worth, as their intention is to then sell it on for a profit. The second option with a pawnbroker is that you can take that item of value and get a loan against it. This basically means that the pawnbroker will hold your item as security for a loan that they give you. Once you have paid back the loan, plus any interest, then the pawnbroker will give you back your item and that's the transaction sorted. However, if you fail to repay that loan by the specified time, then the pawnbroker will own that item and it will no longer be in your possession. Oftentimes, the pawnbroker will then sell that item to recoup any losses on the loan that they provided you. Plus, interest rates that are often higher than retail banks, meaning you're going to pay more in interest. We've made it to the final financial institution, and this one is payday loan companies. Payday loan companies offer short-term, high-interest loans of smaller amounts. These usually need to be paid back by the borrower's next payday, hence the term payday loan. Payday loans are intended to give customers quick access to cash to cover emergencies and any unexpected expenses. If customers fail to repay these loans on time, then high interest rates can mean that they spiral into unmanageable debt. Borrowers should be aware of the risks and costs involved with payday loans and should carefully consider other options and stay away from these payday loans.